Ladies and gentlemen, good day and welcome to the Can Fin Homes Limited Q4 FY25 earnings conference call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance in the conference call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nidesh Jain from Investec Capital. Thank you and over to you.
Thank you, Mike. Good afternoon, everyone. Welcome to the Q4 FY25 earnings conference call of Can Fin Homes Limited. To discuss the financial performance of Can Fin Homes and to address your queries, we have with us Mr. Suresh Iyer, MD and CEO, Mr. Vikram Saha, Deputy MD, Mr. Prakash, General Manager, Mr. Prashant Joshi, DGM and CFO of Can Fin Homes Limited. I would now like to hand over the call to Mr. Suresh Iyer for his opening comments. Over to you, sir.
Thank you, Nidesh, and I welcome all of you to the earnings call of Q4 for Can Fin Homes. Just to give a brief of the performance for the quarter and for the year ended March 31, the few points is that the small issue of e-Khata that we had experienced mainly in Q3 of this year, we have seen some improvement in the disbursement position and some e-Khata releases also happening, as a result of which our Karnataka disbursements in the Q4 have increased by almost approximately 200 crores compared to Q3 of the year. So basically in the month of January and February we could do about 200 crores each, and in the month of March we have touched 300 crores. So that's one positive point, and as a result, with other zones also continuing to do well, our growth in Q4 has been 31% compared to Q3. Just to give a brief, our North Zone, West Zone and Tamil Nadu zones have grown at 30% plus 16% and 25% plus respectively for the entire year. In terms of the guidance for the current year, that is FY26, we are very positive that we should be able to achieve a 20% growth in disbursements because the three of the zones, major zones, are already performing well, with Karnataka also looking to come back to the old numbers, and what we had seen in H1, even Karnataka should be doing around 20% plus growth, and Telangana, which was an issue for us, has also kind of reached a level from where now we expect that we have bottomed out. Already in Q4 we have started seeing a small turnaround from the bottom of 70 crores that we had done in one of the months back to about 100 crore plus. So we are confident that even Telangana should start would be in positive in this year. So in terms of the growth, we are confident about 20% growth in the FY26. As for performance of the recovery, during Q3 we had the increase in the SMA 0 because of a change in the regulatory guidelines, which we had indicated that we would be working in explaining to the customers, educating them, and more aggressive follow-ups for SMA 0. So that has been done, and we are happy that to show that the number of 770 crore which had gone up or was on account of the less than 1,000 rupees overdue, we have been able to collect a majority of it, and as of the end of Q4, this number of SMA 0 has come down by an almost equivalent 750 crores. And even our NPA numbers have reduced in absolute number as well as in percentage, and it is at 0.87. We would, as indicated in the previous quarter also, we would say that 0.90 is the kind of numbers that we are saying would be we can kind of look forward to. It should not be any increase beyond that. So in terms of the reduction in SMA 0 and the reduction in NPA, we've had an actual write back in our ECL provisions in Q4 to the extent of about 10 crores. However, as a prudent measure, the management has taken a call to have a management overlay of additional 25 crores. So there was a 34.28 crore management overlay being carried. Added to that, another 25 crores has been done in this quarter, as a result of which our management overlay now is at around 59% or approximately 15 to 16, 17 bits of the overall book size. So net, if you exclude the management overlay, the ECL provisioning or the credit cost would be around 50 crores approximately, which is about 13 bits, which is lower than the 15 bits that we have been guiding for throughout the year. In terms of the other areas, as in terms of the strategy that we have been talking about in terms of a shift to a little more towards the SENP category and a little more towards the north and western regions. The situation is that from a beginning 2 years back of about 89% of portfolio being housing, including CRE, it has come down to 85%. So there has been a gradual reduction, and we would like to, in the next 3 years, take it down to around 80%. That is including the CRE for housing. Even the SENP, which we had indicated was around 72% was salaried, and 28% was SENP. On the books now it stands at 70% salaried and 30%. So there also the journey has been going on, and in the next 3 years we would like to take it down to 65 salaried and 35 SENP. So that journey is also on course. In terms of the branch expansion, there was a plan to open 15 branches during the year, which has also been opened. So the current position stands at 234 branches, and the new branches also been able to contribute and throughout the year, and they have been on course for a normal, reaching the profitability in 18 to 24 months time, which is a normal thing. In terms of the current year, we plan another 15 branches in FY26, again predominantly in the north and the west, and a little more few in Tamil Nadu as well. So we are looking at the ending FY26 with around 249 branches. In terms of the profitability and in terms of the ratios, our guidance of 2.5% spread, 3.5% NIM has throughout been maintained in the last year, and we would continue to maintain that kind of a guidance for the current year also, of a spread of 2.5% plus and 3.5% plus NIM. Which would therefore allow us to maintain a ROE of 17 approximately, and ROA of 2.1 to 2.2. The positive part is that for the first time in the company's we have crossed in terms of the PBT, we have reached the 4-digit mark, which is for the first time in the history. So that is one positive in terms of the profitability. And so in terms of the guidance for the current year also, we would like to have a spread and NIM of 2.5, 3.5% plus, ROA of about 2.1, 2.2. That is what it is we are looking at. I once again welcome all of you to this, and I throw it open for any questions, if any. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. We have the first question from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Hi Rajiv, we are not able to hear anything. You're there?
Can you hear us? Can you hear me now?
Yes, Rajiv, please go ahead.
Yeah. So, sir, how are we going to ensure that SMA1 and SMA2 accounts doesn't flow forward, and what mechanisms are put in place for that?
Sure. See, actually in SMA0, basically it was more of a small change in regulation where the advance, whatever was there, had to be adjusted to principal, and nothing was being carried. So basically we moved over with educating the customer and being more aggressive in terms of our follow-up with the customer for the charges, also changing the text of the pre-NAT intimation and all those kind of things, which we will continue now throughout. This is the new norm. Now we'll be more explicit in our communication to the customer. So that's basically what we will continue to do. Focus on SMA, or we also have a probable SMA, like for example from 15th onwards we start following up with customers whose current month EMI has not yet come, because our NAT cycles are 5th, 10th and 15th. So those where there has been a bounce, obviously it starts from the very next day the check bounce happens. And even otherwise for the rest also we have this probable SMA 0, which we start following up from the 15th onwards throughout.
Sir, sorry, my question was with regards to SMA1 and SMA2. Yeah.
Yeah, so basically the SMA numbers also we will be the same. We have to be following up with this only. We are increasing the number of staff also in some of the branches where the numbers are little high, and plus we also have increased the call center this thing, because as the base increases also we need to have that pressure. So we have also increased so that the repeat calls can be made also to our existing customers. We are also initiating and following up for skip tracing wherever the numbers are not going through for 3 or 4 calls and stuff like that. So these are some of the steps we have also increased or added to our current processes so that we can work on the SMA1, SMA2.
Okay. And sir, my question is on management overlay. So what do we see as the benefit of topping up management overlay or even holding management overlay? Because we didn't utilize management overlay in early FY24 when we had that Ambala fraud provision. We made a fresh provision without utilizing the existing management overlay then. So how and when can this management overlay be utilized for us? And especially, this question also assumes significance because you also have 49 crore worth of restructured provisions which will get rolled down or released over the coming years as these accounts are closed or transferred. So you already have some kind of a buffer of provision coming in the future, and plus you're topping management overlay whose utilization of how and when is not very clear. Can you just throw some light here?
See, basically, this restructured portfolio provision that we have been carrying is more of a regulatory requirement, and it will be coming down as and when the portfolio gets released. That is gets closed. So if you see, we started off with an opening restructured book of about 720 crores. The principal at that time was around 680 or something. So we started off with a 68 point something crore of restructured COVID restructuring provisioning, which now as and when the portfolio has come down to around 480 odd crores, this provision has also been reduced, because as and when the portfolio gets cleared or closed, the account gets closed, this will come down. So over a period of the next few years, as and when the portfolio goes down, this provision will completely become zero. It will be withdrawn, and that you would have seen in the last year or 1.5 years, 2 years also, we have been exercising that and reducing that provision. In terms of the management overlay, it is purely just a prudent kind of thing. There is no major concern or anything that has resulted in this management overlay. But it's purely because from the old PCR concept, where we are at least some of us are used to a net nil NPA also. In the ECL provision calculation, in fact, our stage 3 provisioning comes to somewhere around 45 to 48% in that range only. Therefore, it's a very low number. So from that point of only, we have at least thought that, somewhere in the range of about 15 bps extra, if that can be carried. So that was the logic, just to have some kind of 10 to 15 bps extra. So that's the only logic, and otherwise there is no reason to say that there is a major concern or anything, except that during the quarters there are some fluctuations. So this gives a little more comfort that if at all some fluctuation, though there is like it happened in this regulatory change which happened in Q3, if that is, but that otherwise is not a major reason. So you are right in a sense. There is no sense in as such carrying that provision, because so far, at least in the last 2 years, we have not actually utilized it. Even when it did go up, we made it from the current year profits we provided for the additional provisioning. So from that point of view, it is purely a buffer. It is purely a comfort and a strengthening of the balance sheet and nothing more.
Okay. Sir, that's it. Thank you, and wishing you all the best.
Thank you.
Thank you. We have the next question from the line of Shripal Doshi from Equirus. Please go ahead.
Hi, sir. Thank you for giving me the opportunity. So my first question was on the cost of fund movement. So given the consecutive rate cuts, how do you see the cost of fund trending in FY26? And how will we pass on the rate benefit to the end customers and its implication on the margin for FY26?
Sure. Thanks, Shripal. See, we had a 25 bips reduction in the month of February, and further another 25 bips in the month of April. So we have the entire bank borrowing portfolio that we have about 55% or something. That entire portfolio is either linked to the repo rate or 80% of it, and the remaining 20% linked to the T-bill. So those 80% of the bank borrowings that we are having, the benefit of the first repo rate cut was passed on to us in the last week of March when we made the interest payments, because the reset happens on a quarterly basis at the link to the interest payment frequency. So that 55%, whatever impact is going to come to us, is roughly going to be around 5 to 7 bits, which is going to be effective from 1st of April for us. The second benefit of the rate cut is that, the Q4, we have been able to, we raised commercial CP, which is about 7% of our book, at approximately 7.3 to 7.4%. Whereas now the CP rates have come to below 7%. So that way, in fact, today, in fact, earlier when we were looking at something, it was almost a range of 6.6%. So anywhere between 6.6, 6.7 is what you can consider. So there's been a good amount of reduction in the rates at which we are going to replace the CPs also. So net, I would assume that the combined effect of both 50 to 60 bips on the 7% CP that we carry, plus the 5 to 7 bips that is coming on the entire book because of the 55% bank borrowing would translate to somewhere around 10 bips by the end of this month for us. So we will look at the next ALCO meeting. We will definitely be considering whether we can pass on to the customers the 10% that we are experiencing. But it will not have an impact on our spread or NIM because we know we will be passing on to the customers only after we experience on the liability side. So we don't expect to have it impacted on our this thing. And as for the yeah, sorry.
Yeah, sorry, please go ahead.
So I was saying, so in terms of the lending, normally, when there is a lag in passing on to the customers, there could have been some impact in terms of the BT out. But so far, we have not seen the incremental lending rates being changed by any of the HFCs or some of the private sector banks also. So it's only on the existing customers the banks have, and that also PSU banks mainly have reduced their rates for the existing customers. But for the new customers, not much, except for a few PSU banks. It has not changed. So in fact, the slight delay in transmission to the customers also may not have so much of at least as of now, at least till now, on the BT out also. Yeah, you were asking something.
So that is this 10 basis point benefit on the cost of fund is assuming only 25 basis point rate cut. So if you also since there was cumulatively 50 basis point rate cut, is it fair to assume that the benefit will be 15 to 16 basis points?
Yeah, it would be could be a little higher, up to 2025 also. But the point is that this April rate cut benefit will probably pass on to us by the end of the quarter only. Whereas it is the 50 basis points is as I said, and the CP is already reflected or it already factored in. But in terms of the bank borrowing rates, only the first one has been factored in because we have had only one interest repayment cycle in March. But for the April one, the interest repayment cycle will come in June. So only post that we will experience the second rate cut benefit for us on the bank portfolio.
Got it, sir. And there's no impact on margin is what you are highlighting for the full year.
Correct.
Got it. Second question was on the provisioning bit. So we're carrying almost 15 to 16 basis point of this management overlay. So is it fair to sort of assume that next year we might do provisioning which will be lower in terms of the run rate or from the guidance point of view, as we can also absorb some bit from here?
As for the provisioning, yes, it will definitely be below 15 bits because, whatever impact of the restructuring, whatever impact of the stickiness, whatever other things have all been factored in. So the present, what I would say, the present NPA of 0.87 is there is the figure which is not going to increase or is not going to see any major change. So having said that, I believe next year, in fact, the provisioning may not be as much, and therefore we may not be required to make so the guidance of 15 is there, 15 bips for the credit cost, but I guess it should be lower than that.
Got it. So one last question was on the tax rate front. So this quarter, the tax rate was just 16%. Here it is closer to 20%. So what is the, could you just explain the difference here?
No, sure. See, basically, if you go back in time in 23, that is in in October 23, post September results, we had a review of our tax rates, and the 3618 benefit, which was not getting captured into our tax calculation, was done. Therefore, our tax calculation at that point in time, which was 25% without considering the 3618 benefit, was reduced to 21%. And that was what was in line with the industry and everything, because subsequently the 3618 would come later post the assessment. So when we changed that calculation methodology in 2023 October, so at that time there was, for the first 2 quarters of 23, that is June quarter, June 23 and September 23 quarter, there was already a 19 crore excess provision for tax which was already provided for. Now that time, since the post-assessment, the assessment order has just been done this year in Q4. Therefore, that return, that 19 crores has been reversed. So that we have actually reduced the provision for taxation in the current quarter. That is why it is looking at a lower rate. Otherwise, technically for the quarter, the actual provision for taxation is around 242 crores. But because of this 19 crore reversal, because of the assessment order getting passed, it is net is 222 or something. Okay. In fact, this 19 crore, which was also a write back because of a previous year calculation, is also what prompted us to take this management overlay, because it was not, otherwise it would have been, unnecessarily looking at a current year profit, which was actually pertaining to previous year. So that was also one of the reasons which prompted us to also use that previous year income to strengthen our balance sheet.
Got it. So from next year, from going ahead, there will not be any reversal from the tax point of view, right?
No, in fact, the full year of FY25, we have gone with the revised calculation only, which also has now been, as part of the assessment getting closed, has also been accepted and cleared. So basically, now the rate would be 21% approximately, which is what we had in the, which is the real rate.
Got it. What is it? Thank you so much. That was helpful. Good luck for the next quarter.
Thank you.
Thank you. We have the next question on the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Thank you and good afternoon, sir. So just trying to understand on the OPEX side, if I look at your other OPEX, slightly elevated versus what we are used to seeing. Any one-offs there on the expenses side?
No, nothing. In fact, only because of this provision management overlay that we have taken, it is slightly coming in this. We have shown it as this thing. Otherwise, there is no other specific reason for this. No other expenses or one-offs have come in other than this. There is no other reason. It's all been in line with the normal first 3 quarters.
So management overlay that we have created during the quarter would have got routed through the provisioning line item, right? If I'm not wrong.
It will come under the impairment, which will form for part of the cost when we divide the cost to income ratio.
Okay, but not part of OPEX, right?
Yeah, it will part of the OPEX. Disclosure also, if you see the SEBI format, it comes above the line, before the PBT it comes.
Got it. Okay. Fair enough. So the other thing that I was trying to understand is, while in your opening remarks you did speak about things getting better in Karnataka, more e-Khatas coming in. If you could, for the benefit of all of us, help us understand how should we look at things evolving in the coming months, right? What is it that you are hearing from your regional managers on this problem, and what is the status today, and by when are things expected to get fully normalized?
See, in case of Karnataka, at least in the municipal corporation limit of Bangalore, in fact, they have already sorted out this e-Khata issue. So there's been a good trickle of e-Khatas coming out on a regular basis. Whereas in case of the BDA, that is the Urban Development Authority, and the Panchayat area, it is still not been done, although the government has been working towards resolving that issue also. But having said that, even this small impact of this municipal corporation limits getting resolved, what has happened is our disbursements in Q3 had dropped to approximately 150 crores per month. Okay, we were doing about 275 crore per month disbursement in Karnataka, which dropped to around 150 crores in the per month for the Q3. In Q4, things slightly started improving from January. So January we were able to just push, and of course there was also a slight shift in strategy where we started pushing for a little more of LAP, because for LAP cases we don't need a fresh registration because the customer is already having the property document. So for LAP also we slightly pushed, but having said that, this change of this municipal corporation limit e-Khata also helped. So January and February we were able to touch 200 crore, and in March of course there was a little push also, plus a little more improvement in the e-Khata, so we were able to touch about 300 crores. So compared to around 450 to 475 crores or something that we have done in Karnataka in the third quarter, we have done almost 200 crore more in Karnataka alone in Q4 compared to Q3. And with this Panchayat and Urban Development Authority areas also getting resolved, which we hope will happen in Q1, I think definitely we should be back to 75 kind of crore disbursement per month numbers for Karnataka in very soon.
Got it, sir. This is useful. And sir, just to understand this little bit a little better, while you have guided for 2.5% spreads and margins of 3.5% plus, so fair to understand that till now we have not passed on any interest rate cuts to customers, and maybe we will do that in the upcoming ALCO meetings.
That is correct. We have not done, because as I said, we experienced it only in the last week of March when we made the repayments. So now the actual impact is going to come now. So we'll now examine the exact benefit that we are getting and take a call in the next ALCO.
Got it. And as of now, the initial expectation is maybe at the entire liability book level, we'll see a 10 basis points kind of a decline, and which we hope could get passed on to customers.
That is correct. That is correct.
Got it. And so to that end, sir, you also suggested earlier in the call that you are not seeing any additional aggression from HFCs or private banks, even after there have been 2 rate cuts already, right?
That is correct. We have not seen major rate cuts in the incremental lending rates from the HFCs and some of the private banks.
Got it. And so lastly, thank you so much for being so patient. Lastly, this guidance that you gave earlier during the call of a 20% growth in disbursements in FY26, are there any additional things that you would be doing this year beyond expanding 15 more branches, focus on self-employed, focus on LAP that you spoke about earlier in your call, right? Because what I'm trying to understand is somewhere during this year, we are also going to see that tech transformation that we have started, right? So just trying to understand, how confident are we about this 20% disbursement growth this year?
Sure. See, I'll just share some numbers. Like our North Zone, last year consistently throughout the year, quarter on quarter, was able to have a good, healthy growth of 25% plus and ended with more than 30% growth by the end of the year. Same with Tamil Nadu also was consistently able to show a growth throughout the year and ended up with around 25% of growth. West Zone also has had a consistent growth and throughout the year was in positive and ended with around 16% growth. Karnataka was around 20% growth in H1, but because of this e-Khata issue, it dropped and we could end the year with around 3% growth. So technically, FY24 we were doing about 220 crores per month, which was the average, because we did about 2,650 odd crores in FY24 in Karnataka, and that was working out to 220 crores. H1 we touched about 275 crore, which was clearly a 20% growth. But now because of the G-Khata issue, we have come back to just we could end with only a 3% growth. So we are back to 225 crore average for the entire year, and Karnataka has ended somewhere in that range of about 2,700 crore for the entire year. So at 275 crore also, if you are able to do, Karnataka should also be able to do 20% growth. And Telangana also, as I mentioned in my opening remarks, we have reached a kind of a base itself has gone down to a level of just about 100 crores per month, which is way below what we have earlier achieved. So even from here, with the turnaround already started, we have already started witnessing the turnaround. So we can expect at 15-20% growth. So this would be the normal thing. Now the second thing is, last year you would recall we had started this marketing or sales department with a small team of 35 odd people. So in Q3, the team was able to contribute in the entire quarter somewhere in the range of about 60 crore. In Q4, that number has increased to about 100 crores. That is in 3 months put together. So having said that, it gives confidence that this team, with a little more addition of staff and all, should be able to start contributing a little more. Same also for the case of the branches which we are opened into FY24. They have started, a decent disbursement of about 75 lakhs per month per staff plus in the year. And this current year, they would be doing a little more. Plus the branches which we opened this year will also add a little bit. So basically, these are the things which will definitely, contribute. And as for the tech transformation, yes, it is expected in Q3. So we will definitely try to, we're already working towards minimizing the impact, or I wouldn't say there will be zero impact, but definitely we are trying to work towards minimizing the impact of that transition so that, it doesn't affect our Q3 numbers also much.
Got it. So this is very, very useful. Thank you, and wish you and your team the very best.
Thank you, Abhijit.
Thank you. We have the next question from the line of Shweta from Elara. Please go ahead.
Thank you, sir, for the opportunity. I have a couple of questions. The first one being, so you guided for restriction of NPAs to 0.9% odd levels. And for the whole of FY25, we have seen provision for NPAs around 150 odd or 160 odd broader range. So do we expect that quantum also to slide in the forthcoming year? Second is, so I joined that bit late.
I didn't get you. 150 what?
The provision for NPAs, the provisions which have held for NPAs for throughout the year, each quarter has been somewhere in the range of 150 to 150. So do we expect that also to come down, given that we are guiding for 15 bits below credit cost, and also GNPA, we are aspiring to restrict to 0.9% odd levels? That's the first question. Second is on the disbursal front. So I joined that late, so I'm not sure whether you covered this. So given the fact that now you are saying like we close with 300 odd crores per month disbursements, so which means for at the quarterly run rate levels, can we easily put up closer to 30 billion odd disbursements going forward, and Q1 per se will start looking better than what we posted in Q4, around 24 odd billion. And lastly, so you mentioned that the long-term goal, or a couple of years down the line, we'll be seeing 65-35 mix, right? But the DSA sourcing continues to move higher, and it's around 82%, and even for incremental disbursements, it's 80%. So how do you see this sourcing mix changing with that AUM mix shift? Yeah, thank you.
Sure. I'll take one by one. Thanks, Shweta. First, the provisioning side, yes, our guidance would be for about 15 bits, but I am fairly confident it should actually end up below. In fact, this year also, excluding the management overlay, our credit cost has been to the tune of about 13 bits or something only, because we had first 3 quarters, we had a cumulative provisioning of about 60 crores. But in Q4, we've had a write back of 10 crores. So net about 50 crores is what is the provisioning, which works to around 13 bits or something. So next year also, with the majority of the impact of all this restructuring and everything already built in, I don't expect the NPAs to go up much, except for the percentage to be almost in the range bound only. So yes, it could be lower than 15 bits, but as a general practice, we are being prudent in our guidance, and we would say about 15 bits would be the guidance for provisioning, though it could be definitely and would be lower. The second thing is disbursement. We mentioned 300 crores we touched for Karnataka as a state in the month of March. Now, obviously, March is one month where it is always, it's for reasons unknown. It's always magic in March. But having said that, normally, Q1 and Q2 are a little more subdued. So when 2,400 that we have done, I would rather say we would target somewhere around 20% over Q1 of last year, rather than saying that we would, because the momentum of March normally doesn't sustain in April and May, considering there are too many holidays, too many vacations and all those things. Plus also post-March there is always a Q1, Q2 is a little lower. It's 45%, 55% H1, H2 kind of a breakup. So I would say 20% in Q1 over Q1 of last year is what I would say would be a more realistic number for disbursement. Okay. Third question was regarding DSA sourcing. Yes, we have been guiding for bringing it down to 60-40. This quarter, this year we have just been able to bring it down from 82 to 80. So it's been a little slow in terms of the progress compared to what we would want. But it has been a very stable set of DSAs, so there is no reason to kind of discontinue them or to pull them out or stop doing business from them. So basically, they have been solidly supporting us. But yes, our direct sourcing or sales team will also keep pushing, and we will see some improvement coming from there. So yes, gradually this number will come down, and the sales team business will keep going up. But so far it's been a slower progress, but we would like to see it come down slightly.
Sure. Thank you, sir.
Thank you.
Thank you. We have the next question on the line of Umang Shah from Kotak Mutual Fund. Please go ahead.
Yeah, hi. Good afternoon. Thanks for taking my question. Suresh, I have a couple of them, both on asset quality. One is there any particular segment of the loan book which you are in particular worried about, be it the non-housing portfolio, the restructured loans, the SMA piece? Is there any part of the loan book that worries you today?
No, in fact, we have looked at it. Restructuring book was one where we also that's where we started actually doing this management overlay. But now, in fact, we have seen maximum guidance we had given was that 18% of the restructured book would be in NPA. So as we end the year, actually, two things have happened. One is the outstanding portfolio of the restructured pool has also come down from around 720 crores at this peak to around 480 crores or something now. Plus, the ratio also from 18% has come down to around 17%. So during one of the quarters, we had said it might peak to around 18%, which it did. But now, as at the end of the year, in fact, it has actually come down. So in the restructured pool also, we don't see much of an issue. And during the year, we have experienced both. We've been monitoring both the salaried segment as well as the self-employed segment, as well as a little bit of a geography-specific NPA also. But again, there only Telangana slightly, showed some increase and more increase compared to the others. And but there also in the Q4 we have not seen any major change. So in fact, in Q4 that also slightly changed. So I would believe that that also is now under control, and probably we've peaked out in terms of Telangana delinquencies also.
Okay. So Suresh, that brings me to my next question. Then what I'm just trying to understand the management philosophy on provisions, right? I mean, if I look at your last decade, there have been only 3 instances where your credit cost has crossed even just 25 basis points. One such event was Ambala incident. The second, the other 2 years were actually COVID years, right? So barring that, your credit cost has been fairly below 20 basis points. If I look at all the other matrices, be it stage 3 provision cover, be it overall ECL on the book, with or without management overlay, or with or without the provision on restructured loans, it feels that we are adequately covered, right? I mean, so what is it that the management or the board is kind of targeting when we are talking about conservatism? Because it appears that, we are fairly provided for. And if I mean, all through the call, your commentary has been fairly upbeat about credit cost and asset quality. So just trying to understand then what's the rationale of holding the management overlay? And a related question is that assuming we are just holding these provisions on the balance sheet, under what circumstances will these be utilized, right? If we don't really have intention of utilizing it, let's say in the normal course of business.
Yeah, thanks. I just try to explain. Umang. Basically, you're right. I mean, we don't see a major kind of a reason to hold the overlay, except for the fact that post our in the ECL scenario, our stage 3 PCR has always been below 50%, which always we have been used to maintaining at a higher level. So that was slightly one issue where that is, we thought, if we can have something like a 15 to 20 bits extra buffer over and above our normal ECL provisions, that would help. So that was the basic one point. And second, as I had mentioned earlier, this year we also had approximately 19 crore of tax refund, which was pertaining to the FY24, wherein we had in the first 2 quarters of FY24 provided for an extra provision for taxation, which post the closure of the assessment, we have got a refund, or we have got a adjustment in our tax. So basically, that was one aspect also which triggered us to kind of take this view that the same 19 odd crores would also help in, kind of build a stronger book. But otherwise, there is no reason to look at it. As for when we would want to take it back, I guess, there is, as you rightly pointed out, the last 10 years also in gross NPA, we never crossed 1%. In terms of our credit cost, we've not had a major setback or a major spike in any of the years, barring the Ambala incident mainly. So I guess it would be a kind of a buffer. Maybe we'll have to see when we can kind of take a reversal. But as of now, it's purely just a kind of a comfort that we have about 15 bits extra, which is there as a management overlay.
Sure. And just last one is that on stage 3 again, I mean, we run a 100% secured book. In fact, our stage 3 PCR would be comparable or if not better than some of our peers. So do we have any particular stage 3 provision cover target number in mind, or we are comfortable at about 45-50 odd percent?
No, see, actually ECL provision, when we look at this probability of default definitely works based on the performance of the account for the last 5 years, which is a purely actual data-based analysis. But the LGD which comes out is also a factor of the assumptions that we have been taking, and we have been very stable in the assumption that we have been taking right from day one as to in what period the account once moves into NPA will come out of NPA and things like that. So I think these assumptions will remain, and therefore this 45 to 49% kind of coverage on stage 3 will probably continue. There is no other reason. It's purely a matter of the assumptions that we have considered for the purpose of arriving at our SGD from the PD.
Understood. And Suresh, just one last question is, I mean, you kind of answered it in fair amount of detail about your conviction for a 20% disbursement growth in FY26. But assuming, if at all there is any disruption in the third quarter because of this whole tech transition, and assuming you have to work with just about 11 months in FY26 when it comes to loan origination, would you still be confident of achieving a 20% sort of a growth rate for the full year? Assuming everything else remains constant, yeah.
Yeah, everything else remaining constant, yes, we are confident. It should be a 20% growth in disbursements, and we are targeting that would be around 10,000 to somewhere between 10,000 10,500 crores is what it would come out to. Yes, we are confident that unless there is a major disruption, which we are trying to minimize, there should not be a major change, and that should not impact our growth target of 20%.
All right. Perfect. Thank you so much for taking my questions. Wish you all the best.
Thank you, Umang. Thank you.
Thank you. Participants are requested to kindly limit your questions to one per participant. Participants are requested to kindly limit your questions to one per participant. We have the next question line of Kushan Parikh from Morgan Stanley. Please go ahead.
Sure. Thanks for taking my question. My question is largely on the margins and the lending rates. So we spoke about passing on the cost of fund benefit as in when we experience it to the customers. Just hypothetically wanted to understand if this practice works in the sense, will customers continue to remain happy with like 10 bits kind of pass on in terms of the rates going forward, as in when we see the benefit in our borrowing costs, and that should be sufficient to keep the balance transfers in check? Or if we see any aggressive rate cut coming in the market from banks, will we also have to follow suit? Or do you think that is sufficient on a regular basis?
See, traditionally, HFCs have been following this practice of passing on only after they experience it on the liability side. And this practice, I think, is a generally accepted practice in the market. The second thing is that in the current scenario where, as I had mentioned, that the current HFCs, the players have not reduced the rate because none of them have experienced the benefit on their liability side. Two, even some of the private banks have not increased or reduce the rates for the incremental lending for their customers. So even if my customer wants to shift, they will not be able to get the reduced rate because that is only for the customers who were in the books of a bank as on a particular date of the repo rate cut. Whereas for the incremental rates, it continues to be the same. Okay, and in fact, the pressure is still there on the banks for borrowing because the deposit rates have not come down. And in fact, what we have experienced is that banks have still been reluctant to pass on the repo rate cut on incremental loans. So, for example, a bank which was ready to lend which was lending to us prior to the rate cut cycle, was lending to us at repo rate plus 150 basis points, roughly around 8%. That is now saying that even after the reduction, they would be comfortable giving it at repo rate plus 170 bps. Basically, because they are also having a pressure on the spread on the margins. So going forward, also I don't expect that incremental lending rates to come down that fast, although it may have some impact to the customer. So I guess a 10 basis points will be sufficient, provided others are also in the same line. The second point is, whether there will be a BT pressure. Yes, normally in such scenarios, because of the lag effect, there will be some impact on BT out. But, at least March, we have not experienced it. And as long as the incremental lending rates do not come down, the other players also will not be very aggressive to cut their rates.
Understood. That was quite a detailed answer. That answers my question. Thank you.
Thank you. Thank you, Kushan.
Thank you. We have the next question from the line of Aditi from CD Equisearch. Please go ahead.
Good afternoon, sir. So my first question is why have the dividend payout ratio increased substantially this time?
Sorry, dividend payout ratio?
Has increased substantially this time.
Okay. So basically, the general feeling was that, there has, for the retail, which is about 22% of our, shareholders, there is at least a dividend payout ratio used to be in the range of about 8 to 10%. So at least we thought a 20%, close to 20% dividend payout ratio would be healthy. So that's the main reason why we have been doing it. But I guess now that we are almost at 18.9% or something as the dividend payout ratio, I think now going forward, probably we will kind of limit it to this 18 to 20% range of dividend payout ratio. But basically, it just started with the thing that we should at least be having a 20% kind of dividend payout ratio, which for us was very, very low about, say, 3 years back or something, as low as about 7-8% or something. So that was the only justification. But going forward, as I said, we might probably retain it at around 18 to 20% kind of a range in which we will want to have the dividend payout ratio.
Okay. And so what are the challenges the company is facing in increasing loan book?
Sorry? Loan book increasing challenges. Sorry, can you repeat the question?
What are the challenges we are facing in increasing the loan book?
Obviously, the challenge is that we need to have a higher growth in terms of our disbursements. We are having a 16% rundown in our book on an average for the entire year. So obviously, if we have to do a 20%, we will have to do 35-36% of our loan book, which is what we will have to disburse in the current year to have a 15% AUM growth. So basically it's clearly a function of our disbursement that will drive the AUM growth.
Okay. So, and how will that happen? Like, are there any macroeconomic challenges that you're facing?
Yes, we have been discussing that. And so last year, in fact, we had a challenge on two fronts, two of our major markets basically, that is Karnataka and Telangana. Karnataka was more of a temporary issue whereby, the registration process was changed in the state, as a result of which we have had some delays in the registration of documents, sale transactions. That affected our business, and the state where we were experiencing about 20% growth had to slow down, and we ended up with around just a flattish or a 3% growth in Karnataka. And it's a major market for us because that contributes about 30-35% of the incremental disbursements for us. The second market where we were affected was in Telangana, where more of a sentiment issue, and I would say more of a long-term thing where there would be a change in the entire growth for the state itself. But having said that, there also we have kind of bottomed out, and I believe from here onwards, on that lower base, we will definitely have a growth from there also. So these are the two major the reasons why we've had a impact on our growth in disbursements, which has affected our AUM growth.
Okay. And sir, are you planning any change in funding mix to make to reduce the cost of borrowing?
Madam, we have about 55% borrowing from our banks, and the only change I would see is one is that NCDs we'll have to raise a little more because we have a requirement of 25% of incremental borrowing has to come from market, which will be NCDs basically. So that now, which is around 19%, will slowly inch up to 25% in the next 2 years and would probably remain at that. The second change which would happen is that the National Housing Bank has come out with a mortgage-backed securities fundraise program where they will be raising bonds or NCDs basically, and against the receivables of the portfolio held by lending institutions, and that is HFCs to start with. The pilot project is being currently under process. So they would be doing it. Once that process is done, I think the NHB is planning to now, going forward, raise more funds from the market and then give it instead of a refinance where there are limitations in terms of how much they can lend. So that would be another source which would open up for us in the current financial year. We are also looking at participating, and so the program is like that the NHB will raise and also be one of the participants to that, and so that will be giving us something like a enhancement for us for the institutions, because they are the ones who are also doing this inspection and monitoring of the HSC. So they will be also coming in as one of the backups for this, and there will be an MRR of about 10%, which the institution will have to have, and that as a pilot is being worked out. Once that is successful, more and more HFCs will be getting involved and participating in that mortgage-backed security debenture issuance, which should also increase our borrowing avenue.
Okay, sir. Thank you.
Thank you.
We have the next question from the line of Pawan Kumar from Ratnatraya Capital. Please go ahead.
I wanted to understand about what would be the cost to income next year, because the thing is FY25 there has been the decrease in terms of the OpEx. What I see, given your IT investments, etc., what do you think will be the cost to income going forward, maybe for the short to medium term? And also, one particular thing I noticed on your balance sheet was the amount of investment has gone up, and so has the debt. So what is the reason behind that? Can you just throw some light?
Sure. So first is the cost to income. So the cost to income, in fact, for FY26, we don't see much of a change. It will be almost in the 17, give and take a few basis points. I think that would be the cost to income ratio for the current year, because the IT transformation costs that are going to come in will actually kick in from FY27 April only, because FY27 only, that is April 26 only. The reason being that, the project was given in the month of January. So there is a 12-month implementation period followed by a 3-month handholding. So basically till March 26, whatever expenses are there will all be capitalized as the project implementation phase. And therefore, the actual cost, which will be the depreciation as well as the annual maintenance contracts and all those things, will start coming in from FY27 only. So FY26 we expect the thing to be around 17%, but FY27 onwards, I think it would go up by about 1 percentage point, somewhere in the range of 18% it should be, because the total cost would be around 55 crore, including the capex and opex. And but the current 15 crore that we are spending currently per year for our IT expenses, that will stop post our moving to the new CBS. So effectively, the net impact will be about 40 crores for the year, which will be around 1% of the overall this thing. So FY27 we can expect the cost income ratio to increase to around 18%, but for the current year we think it will be around 17% only. The second is the investment in IT.
No, market investment.
You're talking about market investment, right?
Right. I was asking about the increase in debt and also the other side increase in investment.
Yeah, the investment basically is we've done about 400 crores of additional investment for our LCR purpose, because as our book is increasing, we need to also increase our LCR. Plus the regulatory LCR requirement to move up from 60 to 70, and this year it has already moved out to 80%. So from 70 to 80%. So basically, for our LCR purpose, we have had a investment during the year of about 400 crores in terms of our for our LCR. That was the one for the investment purpose. I think you asked something about your increase in expense also, right? IT expenses.
On the debt side, I can see your debt, which is like there is deposits plus your borrowing has gone up from around 33,800 crores to around 38,000 crores. So I was just like, what has changed in this particular quarter for that to have happened?
No, I think there is, if you're going by the presentation, first of all, my apologies. There is one small presentation page where I think the total borrowing is showing as 38,000 crores, right? I think that is what you're referring to.
Right.
Yeah, actually there is a mistake. It is 35,000. I'll just give you the, I think I'll just a second.
All right. I got it.
35,289 crores actually. So the increase in borrowing has been to the extent of about 3,400 crores, which is similar to the kind of increase in our AUM also.
Okay, got it. Thanks.
Yeah.
Thank you.
My apologies.
Thank you. We have the next question on the line of Sahej Mittal from 3P Investment Managers. Please go ahead.
Hi, good evening, team. So just one clarification. So our disbursements in 4Q X of Karnataka and Telangana is around 1,450 crores. Is that number right?
No, I think we have, as I said, 700 crores. So about 1,600 to 1,700 crores is the disbursement other than Karnataka for us in Q4. We have done a 2,455 crore disbursement, of which about 700 odd is from Karnataka. So 1,700 approximately, somewhere that number is where we have done from other than Karnataka.
Okay, and this number for 3Q would be?
For 3Q would be in Q3 we had about 1,879 crore total disbursement, of which about close to 470 or something was from Karnataka. So roughly about 1,400 or a little less, 1,400 odd was from the rest of the states. So 1,400 and or something has gone up to 1,700 in Q4.
Got you, sir. Perfect, sir. Thanks and all the best. This is it.
Thank you.
Thank you. We have the next question from the line of Gaurav Jaini from Prabhudas Lilladher. Please go ahead.
Yeah, thank you, sir. Firstly, sir, just wanted your assessment of, given the deposit rate cuts, how do you plan to sort of control the repayment rate in FY26, right? Because banks have already started reducing deposit rates, be it bulk or SA. So I'm sure there'll be an increase in competition in the housing space. So, how do you plan to tackle that?
So actually, yes, we earlier were discussing that we will be passing on some benefit of the, borrowing cost advantage benefit that we get in to our customers, about 10 bits right now, and probably, another 50 odd bits in Q2 is what we will be might be able to pass on, which obviously will be lower than what banks are doing. So, particularly in a 50 lakh plus segment where, the competition is definitely there directly with the PSU banks and the large private sector banks, there could be some pressure, and we will have to look at, some retention or something for the customers, and maybe. So that we will be depending on the strength of the case, the score, credit score, the interest rate, we will be looking at something on a case-to-case basis for those customers. But for the below 50 lakh, probably it may not be as much because the main competition is mainly from at least up to the 35 lakh, mainly from the other HFCs and smaller banks. So it is beyond that, which is a small percentage for us. We will definitely have to look at some retention policy. We will over and above what it is there. So depending on the CIBIL score, depending on the repayment track, we will have to look at we will be reviewing our policy.
So, and sir, just want to reconcile some numbers and just wanted your comments on growth, right? So, assuming a 20% disbursement growth on a 15% repayment rate, that translates to about a 12% AUM growth. So, how do you plan to actually increase that number going ahead?
See, current year, yes, we are looking at a 20-odd% growth. Our rundown generally is around 1,300 and something crore per quarter. So approximately 5,600 crore is the rundown that we are looking at for the next financial year. So to have a 15% growth, we should be somewhere in the range of about 10,500 or something crore is the disbursement we should have to be able to arrive at a healthy growth. So obviously we will be trying for that, and that is what we have said, that 20% disbursement growth resulting in a 13 to 15% AUM growth is what we will be looking at.
And then lastly, if you could just quantify the investment income for the full year. Last year it was about 125.8 or 126 crore.
Yeah. Investment income. Just a second, we'll come back on that. I don't have the exact figure.
Yeah, can you cover investment income? Can you specifically come?
Yes, 126 crore was last year, full year 24. Can you quantify for FY25?
I think we'll just come back to you on that.
Sure. So that is it from mine. Thank you.
Thank you. Ladies and gentlemen, that was the last question. I would now like to hand the conference over to Mr. Suresh Iyer for closing comments.
Yeah. Thank you very much. I once again thank all of you for taking your time out, and I hope all the queries have been answered. And we look forward to, if there are any more queries, feel free to always get in touch. I guess we have answered. I'll just come back on the investment income. Probably I'll revert back to Mr. Gaurav. Right. Yeah. Thank you once again to all of you for joining the earnings call for Can Fin Homes.
Thank you. On behalf of Can Fin Homes Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your